Good evening. Welcome to another edition of the ShadowTrader Video Weekly. I'm your host, Peter Resnicek from ShadowTrader.net. Is the Powell put in? What exactly does that mean? Earlier this week, Jerome Powell of the Federal Reserve made some very dovish comments that could have implications for the market throughout 2019. If you recall in last week's video, I said that it was possibly the most important week of the year, given that the S&P was right up against a very key trend line. We ended up breaking that trend line this week, and now the markets are sitting at another important juncture. I'll tell you exactly what that is as well. CBOE Volatility Index, also known as the VIX. We don't talk about it that often, but when it's at a very key level, it does bear mention. So we're going to take a close look at the VIX in this week's video and see what that might be telling us for price action going forward. And last but not least, a quick look at FAANG stocks, all of which have reported already, except for Google, which is going to report on Monday. So far, so good. We're going to see what the implications of that are as well for the market going forward. All right, let's get into it. Okay, so let's start with this daily of the SPX here. And let's first address this thing about the Powell put. What exactly is the Powell put? So this is the Wednesday price action in the S&P, and it was actually the day that we broke the big downtrend. And this is what I was talking about in last week's video when I was telling you that this is going to be the most important week of the year because we were close to approaching that downtrend. And what happened on that Wednesday essentially was that Chairman Powell of the FOMC didn't raise rates. That was expected, that was baked in, not a big deal. But more importantly, in the press conference after and in the comments that always follow, he basically used the word patient to imply that the Fed would be on hold for possibly all of 2019. If you recall from last year, the Fed funds futures were pricing in that there would be a minimum of 2 hikes in 2019 and maybe more. And now it seems like the Fed is backed off of that. And they seem to be telegraphing to us that there may be no hikes. And that's what's called the Powell put. Essentially, it's when Chairman Powell basically puts a put on the market, which is something that protects the downside, through the comments that he made, which seem to be very dovish. And of course, stocks tend to like that very much. There's a lot of research out there, and you can certainly check this out on your own, that says that basically markets really follow monetary policy more than anything. And the longer I'm involved in this game, I can honestly say that from my perspective, it does really seem that way. It seems to me that the market is more sensitive to that than anything else, that all the other nonsense and news and whatever and all these little mini crises that we have all the time doesn't matter as much as what the Fed is going to be doing in terms of monetary policy going forward. So now it seems like they're signaling dovish, and the market likes it. The market broke that uptrend, and as we can see, has floated higher into the remainder of the week. All right, now having said that, having floated higher, here's where things get very interesting for this week, because now we're at another key juncture, which is this 61.8 fib. This is really the only Fibonacci level that matters. I know there's 38.2, there's 50%, some people do extensions, there's 70-something%, whatever, but really the golden ratio, the most important fib number, is always the 61.8. And again, from my experience in using Fibonacci in trading, I have found that it is the 61.8% retracement that is most reliable as far as a turning point in any time frame. This can work on a day time frame or even on longer time frames where the charts are pushed out to weeklies or monthlies. So I always pay very, very close attention to 61.8s. It's really the only fib level that I really pay attention to. And as you can see in this SPX daily chart, from the all-time high, which happened way out here in October of last year, all the way down to this recent swing low, which was in December of last year, we have now rallied up right to the 61.8. We actually breached it by just a couple of points on Friday before backing off a little bit and creating this small reversal bar here on the charts. Now, does that mean that we're definitely going down next week? I don't know. I mean, certainly the market basically stopped where it should have, but obviously we don't know what the price action is going to be in the next week. Now, looking at the other majors, I do want to make clear that it does appear to me that even though we are up against that 61.8, the edge is to the bulls, right? One, we just talked about the Powell put, so it seems like the market needs to digest all of that bullish and dovish monetary policy, and that usually takes quite a while as confidence comes into the market and people realize, okay, stocks aren't going down, and the Fed is going to remain accommodative. And so asset prices will rise, right? So at the same time, looking at the other majors, if we look at the NDX, notice that as I was saying last week, the NDX broke that downtrend a while ago, broke it here. then spent a good amount of time just kind of hanging out around it, and then did what? Floated higher. And again, made that same reversal bar on Friday, and now we're in between the 50 and the 61.8. So really, the only technical resistance for the NASDAQ 100 would not come until approximately the 7,000 level. So being that we have that little bit of room to maneuver to the upside, I would say that, again, the edge feels like it's to the bulls. All right. Beyond that, I always like to look at the Russell, which I think is important. It's often a leader, and this is really kind of key, is notice where it's sitting, right at the 50. Again, not as important as the 61.8, but something to be said for that. Here's your all-time high in the rut. Here's your December low. And again, if you mark off the fib from that level to that level, takes you right to the halfway marks. This is kind of interesting as well. We broke trend a while ago in the rut, just like in the NDX, and I think it was a cleaner break. Notice that we just went up and didn't, and when the Russell spent these other candles here balancing, it did it on the opposite end of the trend line, on the north side of it, whereas the NDX was kind of like that on both sides. Then you balanced a little bit here, and again, moved right on up to that 61.8. Okay, let's talk volatility now. Here's something we don't discuss all that often, but when it is at a key juncture, I do believe that it is important and noteworthy. And what I'm talking about is the CBOE Volatility Index, also known as the VIX. A lot of people think of this as the fear index. Without going too deeply into how this is calculated or what it means for option pricing, which is really where it comes most into play, we do have to pay close attention to support and resistance in the VIX, especially extremes. And now the VIX has come back to an extreme. So notice that as the market has slowly ground higher, in some cases not so slowly since December, notice that volatility has fallen back to where? A very, very important level, which is this 16 handle in the VIX after being up as high as in the mid-30s here. And you can see we've just had this sort of slow bleed of volatility lower. Right? This area is very, very important because it represents the floor of this whole section here of higher volatility in the charts, correct? Because before this, which is before October here, what was the VIX doing? Nothing. We had very, very low volatility in the markets, which was moving lockstep with an equities market that was just a slow grind to the upside, right? Every day seemed to just be an up day. The pullbacks were very, very mild. We saw that in that whole time period coming up to November of 2018, and it stayed that way for a long, long time. And that period in equities was characterized by a VIX that was basically bumping around between 12 and 16, and then we broke above 16, and we have all of this action. Now it's a much higher volatility environment above 16. So this is very, very important in the coming weeks. What's going to happen at this 16 handle? If it doesn't hold and volatility doesn't move higher, which obviously would take the market backing off from that 61.8 and get some sellers into the market, volatility could have a slow dribble lower, which is usually how it works, and actually come back into the sub 16 and north of 12 range. That would be a very, very big tell, I think, for the market, because it may just herald that the SPX is going to have another slow grind to the upside, just like before. Basically, what's going to happen is this 61.8 will be taken out, and you'll just see this kind of slow burn to the upside. And we'll see 2,800, and who knows, maybe we see the all-time highs. But definitely, that VIX is very, very important, so pay close attention. Okay, last but not least, I want to talk a little bit about FAANG stocks. They have all reported now, except for Google, which is going to, I believe, if I check my blotter, it's going to be PM on Monday, so February 4th in the afternoon will be Google's report. We have already heard from Facebook, Apple, Amazon, and Netflix, which is the first four in the FAANG, and so far so good. I talk about these specifically because I think they really are barometers of risk. I believe. I think it definitely signals a risk-on, risk-off environment. You can see that these stocks got very, very beaten up in the recent sell-off after October. But notice that, again, as far as trends are concerned, Facebook is a good example. We'll start with that. Notice where the trend line break in Facebook occurred, right here around January 8th. And since then, it's been kind of a slow grind higher. And when they reported earnings this week, huge gap up, and so far a hold. A lot of people think this is a definite short. It'll fill the gap. I disagree. I may be wrong, but 9 times out of 10, what usually happens is big gaps consolidate. They just stay there and do nothing, and there's sort of a reset of price action, and things just kind of stay there. All right. Apple, same thing, kind of down in the dumps, huge downtrend, broken, and so far now just this kind of slow grind higher, and then they report, and we had this candle on the upside and then bounce a little bit higher. So actually the market likes that. Netflix reported actually much earlier. It was here. It rallied into its report, then sold off. Since then, it's been climbing higher. And last but not least, Amazon was the only negative report. And you can see here, I've put an alert here as far as where it reported, going back up to that level. It was negative on the report, but you can see that range-wise, not a lot of damage has really happened to the chart. And if anything, if we do retest this area once again, you can expect it to go much higher, obviously market willing if we have that kind of a market. But so far, we're still in range in Amazon. In the coming week, I want you to pay very, very close attention to this 1600 to 1590 area, basically. In Amazon, it's the low end of this larger range that it's stuck in, and that could be a very, very strong buy in the stock, especially since you've got kind of a right or right out type of scenario. You know that if you start to go deeper into the 1590s, well, then it's probably not working. But for now, it's probably going to be a pretty strong support point. All right. Okay, so that's all for this week. Let's just recap really quickly. We're at a very, very key level. Once again, last week, as I was saying, was quote unquote the most important week for the markets to see if we could break trend. We did break trend in the SPX, correct? But since then, we've just sort of dribbled a little bit higher, right to a key 61.8% retracement. That's going to be where everybody's focus is this week. If we don't back off from there and continue to consolidate, you can expect the market is probably going to push higher. If we pull back a bunch and then go right back and retest that 61.8, that's a buy. It also means higher. Basically, the only thing that's going to be negative in this week is if we were to come back under the Fed move. That's your barometer right here. The only thing for longer-term traders that's really negative is if we take out the Fed move and go back to this consolidation area around the 2650. That may bring in stronger sellers, but barring that, it does feel like the edge is a little bit to the bulls. All right, that's all for this week. Thank you, as always, for tuning in. Recently, there's been a lot of new subscribers to my blog, which is called The Peters Pre-Market Perspective. I want to give a quick shout out to Terry from ShadowTrader, who did a promotion with us recently and gave out the blog free to all his subscribers. And it seems like a lot of people came on board, and I'm very appreciative of that. If you haven't checked it out yet, I do urge you to do so. It's really, really cheap. It's only $20 a month. It costs you $1 a day. Basically, every single morning, I lay out my case for what happened in the market the day before, what I think is going to happen in that current day, and it gets delivered to your inbox every morning at 9 a.m. sharp, so you have plenty of time to digest it. I've got a lot of good feedback on it recently. Obviously, the price point is really low. There's no contract. You can just cancel whenever you like, but a lot of people email me all the time and thank me and tell me that it really helps them to sort of set the tone for their day and at least mark off the key support and resistance levels and different nuances through the lens of market profile that you definitely wouldn't see in a regular two-dimensional chart. I always do say that I wish everybody would have market profile software, but I understand that it is prohibitive for some people. It is somewhat costly. You do have to pay for data, etc. But this may be an alternative. At least with my blog every morning, you do get a snapshot of the profile. And again, I really do work as hard as I can to point out nuances that a lot of people just don't see. And it's very often those nuances in the market that really are the difference between making or losing money that next day. So if you'd like to check that out, it's at shadowtrader.net. Mouse over the Futures Market Profile tab and click on Overview, which is the first choice. And when you click there, you can scroll down and you'll see that'll take you to a link to give you more description. There's also some sample issues there as well. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.